If you're new and haven't done anything yet, let's see what kind of audience we got tonight.
Buy and holds. Great. This helps us so we can kind of tailor the message to speak specifically into what you're doing. Let us know too if you haven't started anything and you're just investigating what your options are. Great.
Yeah, we got Jimmy doing buy and holds, Sharon buy holds, really wants to get into multifamily. Yep. Ed just starting out. That's great. I wish I had, I think the resources were there, but I wish I would have taken advantage of resources like ICOR when I was first starting out in the real estate world. Chris, buy hold. Yep. Randy and Grace wholesaling. Yep. That's how I started.
All right, 6:04.
Yeah. We'll start in about 1 minute, maybe.
Yeah.
Greg, buy holds. Yep.
Okay. Jason, real fast, are you do folks have the ability to turn on their mics? Since we're not owning this one, I don't know. If anyone wants to experiment and let us know, just so we can let you ask actual questions if you can. I don't know if you have that ability or not right now.
Anybody want to test their mic real quick?
Hi, this is Chris testing.
Chris, hey, good, Chris.
Perfect.
All right.
We won't make you turn on your screen if you're eating dinner, and that's fine.
Yeah. Yeah. So, yeah, shall we get started?
Yeah, let's do it.
Go. All right. Well, my name is Jason Powers and Olivia McGraw here. I'll let her introduce herself, tell us a little bit about herself. But you know, myself, background in real estate investing. I started back in 2008, 9, 10. Started out wholesaling, kind of took that transition into fix and flips over time. I had other businesses along the way, and I still do real estate investing. It's kind of morphed over the years, and I wasn't doing it actively, but I've, you know, upgraded throughout the past 10, 15 years, and just really what's the next thing we can do, right? And I've thoroughly enjoyed it. We got into this industry and in the Unbridled Wealth and teaching people about the flow of money. And the very first thing I was doing was like, we got to tell more real estate investors about this because it's amazing. And if I would have known about this back in 2008, 9, 10, I'd be in a totally different spot financially and my real estate investing. So we're excited tonight to teach you guys about this amazing resource. And I'll kick it to Olivia.
All right. Thank you. Well, first of all, we just appreciate you all joining us tonight and hope that by the end of this evening, you have a new tool in your toolbox. Although I just want to acknowledge right now, it's going to take a little while to implement it. And that's why we're here. Jason and I both have been clients of Unbridled Wealth, turned into practitioners and now teachers. And so this isn't something that's just theoretical for us. It's something that's very practical and that we're literally using as a significant tool inside of our financial strategies. So while we get going here, just our formal disclosure, we will be discussing tax and legal issues tonight. However, we are not CPAs nor attorneys. And so we know great CPAs and attorneys if you have specific tax and legal questions, but just this is our full disclosure that that's not who we are, but we can redirect you if need be. All right, so this is us, Jason Powers, Olivia. So tonight we want to address one of the most significant issues that all of us face, especially if we're looking for investments. The problem is the need for investment capital. Where do we get the money? And so what we're proposing tonight is actually a system that has been around for over 200 years. It might sound new and fancy. It's just new to us. It's actually a system that has been utilized by the wealthiest people in America and the every Fortune 500 company. And these are not just caveats to be like, ooh, you too could be one of these. It's saying like literally this is something that everyone is using. All of the wealthiest people in America are utilizing. Jason and I are just very committed to breaking down the system and making it applicable to real estate investors, those that are just trying to get started, and just saying that, hey, this isn't an exclusive tool for the rich and famous, if you will. It is a tool that they're utilizing. So with that, the common knowledge that we are taught is what, Mr. Rich Dad, Poor Dad, that other people's money is greater than our money, which is true. And we're not saying that that's false. We're just saying that there's actually more information behind this that actually Mr. Kiyosaki himself is implementing that can be a power tool in your tool belt. So we're saying that your bank is greater than other people's money, which is greater than your money. So what does this mean? This means that we are looking to partially or fully replace the banking element within your life by establishing your own bank. Now, this isn't saying that we are fully and, going to be issuing checks and you'll be up and running like Wells Fargo. This is saying this is actually something that banks themselves hold billions of dollars in assets by doing the tool that we're going to talk about tonight. And so our hope and our goal this evening is to make this at least give you the building blocks and the fundamentals to start to understand how and why the system works and why it is literally the perfect tool for real estate investors. The key to all of this is something very important to real estate investors, which is leverage. It's saying that we are going to be utilizing a tool as your leverage option. It's the key to unlocking opportunities far beyond what you're currently doing. All right, so let's just kind of go down the rabbit hole a little bit. And by the way, as we go along, if you have questions, feel free to raise your hand. I know they have the raise hand symbol in there, but also pop a message in the chat too. And Jason and I want to be sure that we're addressing some of those. So this is not just like our talking heads. We want to interact with you and hear from you too. So the common information that we are taught, at least in America, is that there are two types of people. Our first type is that there are the debtors. These are the folks that you need a new car. What are we taught? You go pick out the fancy new one that you want and take out a car loan. And up until a couple of months ago, money was very cheap. And so you could get whatever you wanted at a very low interest rate. Money is no longer cheap, which is what makes this tool even more powerful right now. And so the whole point of a debtor is to chip away at your debt and get back to nothing. The problem with that is that you are just chasing your tail eternally and there's no end in sight. What's our alternative? The saver. This is the, never pay, never go into debt for things. Debt is bad. We all know, since you're real estate investors, there's good debt and bad debt. We kind of feel like this system actually exists outside of all of that. But the savers are told, pay cash for stuff. You want to save up, and then you drain the bank and go out, pick out what you want. And the whole point is to establish that pool of money again in order to go and buy your purchases and investments. The problem with this is that you're giving up the opportunity cost. What could this money be doing while you're saving it up? What could this money be doing instead of sitting in your driveway? What could this money, there's endless what ifs. What could they be doing? What we're proposing tonight is that there's actually a third option here. And this system does have a cost to get going. There's always, it's a cost to everything to get started, but you actually end up recovering that cost to start, and your money literally grows and compounds until the day you die. And so it's not magic, it's just math. And so we're going to go into the nuts and bolts of how and why this works. So let's dig into it. Our hope for the end of this evening, one is to give you some potential, like just some growth and strength training within your financial understanding, which does require you to buckle up and to just join us in this financial education. We are not expecting you to 100% understand this tonight. We are just expecting and hoping that you will get a peek behind what is possible, because what we're going to go into is actually a very specific and strategic strategy that is different for every single client we interact with. And so it's specific to your goals, it's specific to your situation. But we do hope that you leave tonight with a little bit of excitement and understanding that, like, hey, there's another something out there that might be applicable for you. All right, so Jason and I help people discover where money is flowing away from them. So this is a major issue for, especially for folks that are looking for investment capital. Part of our job is to go treasure hunting and to help find out where is that money flowing away. Examples of that might be just the car loan example. Why are you paying someone else for your car when you could be making money while buying your car? And we'll get into that in a few minutes. Number two, where is your money stored? So is it under your mattress? Is it in the sock drawer? Is it in a bank account? You know, I mean, we're taught like the only place to really store your money is in retirement. Lock it away. They'll slap a hefty fine on you if you want to access it early, or in your bank account, which earns, 0.0 nothing. And so, there's not a lot of options that we're typically taught about. So what Jason and I do when we go treasure hunting is figure out how can we redirect that flow of the money and where it's stored so that you literally begin a process of your money making money. So this is not saying like, hey, we're going to lock this money away. And the best way to think of this is like a self-directed IRA or a Roth IRA, where you've already paid taxes on this money. But once it enters into this system, it begins to grow and compound for the rest of your life. So when correctly using the system, and this all sounds very mysterious and like those very annoying, I'm like, we'll get there in a minute. But when correctly applied, we just want to paint a sketch of what is possible beyond this. Number one, your money does make money in more than one place at the same time.
Well, then let's talk about, specifically with real estate, how do we make our money do more, right? When you get into real estate investing, you're wanting, you usually need to borrow money, hard money, private money, depends on where you're at in your real estate investing career. We're going to borrow money and leverage it, as we alluded to make you more money, right? And so you've got a dollar doing a couple things, right? So the private money guy, he's going to make money from you, and then you're going to take that money and you're going to turn around and make money with it, right? But you're also paying the contractor, right? And they're going to make money from it, right? And so the $1 is making money, different people money. It's doing a lot of different things at once. So we're going to kind of teach you how you can do this yourself effectively.
All right. So number two, we're going to teach you how to be the bank. And what does that give you? It gives you the opportunity for unstructured loans, a decision on the rate options, fixed versus variable. We were talking with a client today who literally, he's an economist. He's actually an economist and a professor, which was really fun. He teaches Austrian economics, which is actually underlying all of this, which is give the power to the people. You should be controlling your funds, not our wonderful government. So yeah, he was blown away that you had fixed rate or variable rate options. And then also financial independence. So the whole point of all of this is that you're not being indebted to another entity or human, or that you are the one who is controlling a lot of those decisions, specifically for situations like right now. I mean, who 5 years ago ever would have predicted a global pandemic? How many people were put in a really challenging situation, whether it was through layoffs, whether it was through unexpected deaths in their family, unfortunately, whether it was having those buy and holds where the government suddenly decides that those renters don't have to pay you money. I mean, that's a significant injustice for you as the person who is still obliged to pay the mortgage. Like nobody's giving you a complete break on that. So what if you were the bank in that situation and you could say, hey, if your renter stops paying, let's just hit timeout on that payment. make interest only payments, or you can tell the renter, hey, you can just pay me what you can right now. And because you are actually the bank, there's flexibility within those terms. And so you don't have somebody else knocking on your door saying, hey, figure out a way to make this money come back to me because you're in debt.
And how often, if you've ever done a fix and flip, if you've done a bunch of, I've been there. How often have you done a fix and flip? You open up that wall and whatever was behind that wall just tacked on 30 days to your deal, right? And so, but the hard money guy you borrow from doesn't care, right? He's worried about whether or not you're making that payment. And so this vehicle we're showing you tonight, that's that unstructured. Imagine having an unstructured loan where you decide how long it's going to take to pay back. If you need to hit the pause button, like Olivia said, renters aren't paying, you can't quite get the mortgage. If you're the banking system, you can hit that pause button. So it's unstructured. You can decide how much, how often, how fast, how are you going to pay it? The rate options, fixed and variable, right? Who has that choice when you're borrowing money? They tell you what the rate is and that's it, right? But if the private money lender, the hard money lender is making all that money off of you, or the bank from your mortgage, imagine how much it would change your game if all that interest and was coming back to you instead, or your banking system was making that money, right? And we're not talking about a brick and mortar bank. We're not going to teach you how to build a brick and mortar bank here tonight, but it's your banking system, right?
Right. Yeah.
And then obviously to create the end goal, right? We all want passive income, we want to be financially free, financial independence. We want to have just, we use the word passive income all the time, but we got to put in the work, right? It's active until we can get to that stage, and that's what Olivia was alluding to earlier, right? When we gotta build our system, right? We got to build our banking system, and there's she put a cost up front, to setting up your own system, your own model, right? And we're not talking about at the end, we don't have some, okay, and for $10,000, we'll teach you how to ... We're not that kind of cost, right? We'll teach you how to do this yourself with your own money.
Yeah. So finally, when applied correctly, it means that your money is liquid. That's really important. And there's not a bunch of hoops to jump through. Number two, it's compounding. It has compounding interest, and it does enable you to retire early, or as I recently heard, don't think about just retiring early, retire often. Take breaks throughout your career, to give you established pool of money for you to be able to choose what you want to do. So let's dive into this. I'm going to, hang on, before I do that, just full disclosure, this is a mouthful, but we're going to break down this definition into the individual elements so that it starts to become more understandable. So without further ado, the infinite banking concept is the process of using a properly structured, dividend-paying, permanent insurance policy to finance purchases and investments and repatriate that money so it can indefinitely compound. So I know that's a mouthful, and I do not expect you to fully understand what that means yet, but we're going to go into each of these kind of yellow highlighted areas and explain what this means. And each of these areas too are very important to how and why this system works. I jokingly and affectionately say this is not your grandparents' whole life insurance, because my grandfather was in life insurance, and this is far from what he was doing. This is using life insurance as a tool, and we're going to show you why the properly structured element of this is actually essential to the whole system. All right. So
well, and I was just going to chime in on that comment. Well, right before you talk about this, even my parents, for example, they have their own independent insurance agency for like 20 years. And several years ago, I'm sitting here explaining this to my mother. My dad passed away a long time ago, but I'm explaining this to my mother, and she's sitting there with her jaw dropped. And she's going, "They never taught us this. We sold life insurance, And she's like, we didn't know about this. We sold it one way."
Yeah.
And that's what we were taught. Yeah.
Yeah, it's a niche. If you go out and ask any probably somebody you might even have a life insurance policy with right now. If they've heard of this, they don't actually know how to set this up. And this is with good intentioned people that are selling great products. This is just a very niche area inside of it. So first two essential elements, dividend paying and permanent insurance. What does that mean? Dividend paying means that it is a mutual insurance company and the policy owners become owners in the company. They pay back a portion of their profits proportionate to what you own within the company through your policy back to the policyholders. And this is essential because we use that for compounding interest. I'll explain that later. Two, another essential element, permanent insurance. Most of you have probably heard the phrase and been familiar with buy term insurance, invest the difference. We're not going to go into all the reasons why that's not necessarily great information or great wisdom, but just know that, I'll talk about the difference between term and whole life here in a second, but a permanent insurance policy very simply will last your entire life. There is an initial cost to get going, but you eventually recover that cost inside of your policy and your money starts making money. And finally, it includes living benefits. And so this is essential for those that are approaching and looking more at retirement. To be clear, this is not a replacement for long-term care insurance. However, the life insurance companies know they will pay a death benefit eventually anyway. And so you as the policy owner may as well have access to that money, the death benefit, while you are alive for critical, chronic, and terminal illnesses. So this is above and beyond what you've paid for. And unlike long-term care insurance, which is an if product, if you get sick, if you need long-term care, then you have insurance to help pay for it. We all know that we will expire at some point. This is a when product. And so you as the policy owner should have access to that death benefit while you're alive to help keep you alive a little bit longer or a little bit more comfortably. A major difference between this and long-term care insurance, though, is that the insurance company will not tell you how you have to use that money. There's only qualifying health events to access it, but they won't say, hey, you have to have a qualified nurse come look after you. It's entirely up to you how you want to use that money. A lot of folks end up using that to pay for a family member to look after them instead of paying for going into a home or something. All right, so term insurance versus whole life. Term insurance is very simple. It's inexpensive for a defined period of time, typically 5, 10, 15 years, some 20, 30, etc. And it's inexpensive for a great reason. 97% of those that have a term policy never actually receive the death benefit, which is great news. It means that people have stayed alive. And so it is an if product. If you happen to pass away during that defined period of time, there will be a death benefit. It's valuable. We use this as a way to protect someone's insurability. So that means if you are young and healthy, but you don't have the money yet to get going with a whole life or a permanent policy, we can make sure that we protect your health rating should the worst happen, but then convert that into a whole life policy later. It does not acquire what we call a cash value, which is an essential element in the banking process, but the premiums can be used as a credit to convert into a permanent policy later. Whole life insurance, quite simply, is enforce your whole life. And it is a when product. So when you graduate, pass away, expire, whatever euphemism you choose to use, there will be a death benefit payout. And then each premium that you are paying towards the insurance policy goes to buy a certain amount of insurance that is then paid in full and then available. So your premium is then available inside the cash value to use. Let's see here. Yep, so your cash is readily accessible and the living benefits act as long-term care insurance. All right. So this is kind of the nuts and bolts of how we structure a policy. This is a policy simplified into the 3 kind of essential columns. We'll take a look at a more specific example later, but just to help kind of orient you to reading a policy example. On the left-hand side, we have the premium amount. In the middle, we have the cash value, and then all of this ends up buying a certain amount of death benefit. So just to be clear too, right now, we're going to give you an example. This is not saying this is the minimum to get going. This is not saying what you have to have in order to start. This is just a pure example for the sake of education. And again, there are a lot of folks out there that say, oh, it takes, such and such amount to get going. We don't know you yet, and we don't know your financial situation. Part of our job is to help figure out a strategy and plan to make this work for you. My youngest client is 17 years old. Well, she was 17 when she started her policy, putting in $300 a month. And by the time she's ready to retire, she will have acquired over $500,000 in cash. And that won't be her only policy, but let's get going. All right. So the premium goes into the policy and starts to accumulate the cash value. This cash value grows at a contracted rate plus an annual dividend. So for this example, we're going to say that this person put in $20,000 annually. So that payment can be paid monthly or on an annual basis. And when they put it into the policy, immediately $16,000 is available to borrow back out. Now, the language around this is very important, and we'll get there in a second. But just know that in year one, it was the cost to get going on this example was $4,000. And they immediately can use 16,000 of their 20 that they put in. In year two, this person puts another $20,000 towards their policy, and they have access now to that full 20,000 plus what they had the year before. So it's not that each year it's going to cost you $4,000. Your payment to get going is upfront and only in year one. After this, every dollar you start to put in towards your policy is then available in your cash value and starts to grow and accumulate until you actually recover your initial $4,000 to start. So we're going to speed up the timeline here. This person has put in another $20,000 at year 10. So their schedule and their plan was $20,000 over the first 10 years. So how much do they have in their cash value? $200,000? Nope, $220,000. That's because this money is starting to grow and compound. So they've recovered their cost of insurance. They've broken even on the amount that they've put on, and now their money is starting to make money. And this is money that does literally, it makes money until the day you die because it's life insurance. At the end of the day, there is a death benefit that's growing proportionately as well. So this is important. The life insurance side of this is actually essential because this means this helps us make sure that we don't need to pay taxes on what's inside the policy as long as it's used right and as long as we structure it properly. All right, so for this example, again, this person in year 10 decides to take out a $200,000 loan from their policy at 3.5% interest. That interest rate a few weeks ago was, just kind of your average interest rate. Right now, that is a phenomenal interest rate. And so this is saying, there are capped interest rates on these policies. Right now, our favorite product is capped at 4%. But we have relationships with banks, and we can go into all of that later, that give you lines of credit based off of your policies as well. So for this example, this person takes out a $200,000 loan and is going to pay that back over the next 10 years, an amortized loan, and pay back $37,326 into this policy. Now, if this loan is being used for business purposes, real estate investments, hard money lending, any of that, this loan is actually, the interest on this is tax deductible. Now, this is where some folks get hung up. They say, why would I pay interest on my own money? Well, this is why you're learning to think like a banker. Banks make money by lending money out and making money with that interest that comes back. But here's where the magic happens. When this person is paying back that $37,000, that 3.5% interest over 10 years, the whole lump sum of $200,000 is still growing at compounding interest while the money is out doing other things. And the compounding interest and growth of this example over that same 10-year period is $163,000. Now, if it sounds like magic, it's not, it's just math. It's literally, there's not another vehicle on the planet where if I say, give me $37,000 and I will give you back $163,000, nothing else on this planet actually exists where it grows as if your money never left the system. That's $125,000 in growth simply because you used your money to go make money somewhere else. I know that was a lot. I'm going to pause and see if any questions pop up. but this is going to start to make a little bit more sense as we get into some examples. Part of the main reason why this makes money is that we are borrowing against the policy. We are borrowing against this cash value, not from that cash value. So that's really essential.
And so think about when we say cash value, right? You're borrowing from your own banking system now, right? You've been capitalizing your banking system, and now you're going to be borrowing from your own banking system. And you can begin doing that year one. Like when she showed you have 16,000 in there, you can begin borrowing that the minute there's money in there.
Yeah. Yep.
And creating that growth.
Yeah.
And that growth that she showed you, that's just inside the banking system. That's not even talking about the money that you used it on to make money, even more money, right? That's only the money inside your banking system.
Yeah. So this doesn't mean, this isn't, we'll do some examples to look at what $200,000 can make outside of the bank as well. But this is just simply because you're using the system. So part of the reason why this works is that you are establishing your bank, your little piggy bank inside of the insurance company. So you call up and say, hey, how much cash value do I have inside my policy? They look at your policy and say, you have $200,000. You say, great, I would like to borrow a portion of that. So it's putting a lien against that portion of your cash value. And they're not going to regulate how you use that. So you can go shopping. We say, don't go buy bubble gum. But you can go buy other investments, put it in the stock market if that's your cup of tea, or buy real estate, buy and holds, all of that fun stuff. And so that is locked in at no more than a 4% interest rate. Meanwhile, your bank, your actual money that you're putting into the policy is growing uninterrupted. You're borrowing your money from the insurance company, but they have to give it to you because it's a legal contract and you're a policy owner, which means you are an owner in the company. When you ask for a loan from your policy, they have to give you the equivalent of your cash value. Meanwhile, your money is actually growing uninterrupted.
And they're like, where's the key? I'm like, the key?
Yeah. All right. Do we have a question, or is that
I think Kyle got unmuted.
All right. He's excited.
There we go.
All right. So let's just look at this real fast. All right. This is how banks make money. You're the depositor. You have, I keep wanting to say policy. It's not a policy. You have a bank account with Bank of America. You deposit $1,000 to the Bank of America. Now, this might be, a little heartbreaking, but they're not actually holding onto your $1,000, and it's not sitting in a vault in the back of the bank. They are taking that $1,000 and loaning out 900 of it, right? They then receive back, let's call it a generous 5%. So let's say you wanted to borrow money from Bank of America. They're going to charge you 5% interest to borrow your money back out. So they're going to make $46.80 on your $900. Meanwhile, they're going to toss you a bone of 0.2%, and even that's generous, $2. So they're making $46 and giving you $2. That's $44 or 2,340% rate of return of interest, or rate of interest. Yeah. Anyway, to use the money that you put on deposit and loan it back out. And they're only required to keep 10% of what you put on deposit in the bank. So it's called fractional lending. There's a whole rabbit hole you can go down that way if you want to. It's why banks go bankrupt. Because when a lot of these folks come saying, I want my money back out of the bank, run on the banks, just like in the 1920s, they don't actually have it there to give it back out. And so this is where they get an interest. Insurance companies have to have $1 in assets for every $1 in liabilities. The liability is not that people will come asking for their money out. The liability is that you expire or graduate early. It's that you die before you've paid some of your premiums on your life insurance. They are giving you, they're guaranteeing a payment upon death. And so they're held to a lot more stringent restrictions, I guess, or they have to be making a lot wiser investments. So this is just, like I said, we're trying to introduce you to the banking concept, and we don't expect you to understand all of this tonight, but just that's kind of an overview. If you want to go down another rabbit hole, look up how much life insurance banks actually own. We pulled up the 2020 report for annual report for Wells Fargo. They bought $1.2 billion in life insurance in 2020. And I think they hold, oh gosh, I can pull it up, but they hold, I think, around $10 billion in life insurance. So that means any employee coming in, they're taking out banks just like this. They're starting whole life policies, taking your money that you're depositing with Wells Fargo and buying life insurance with it. And when that employee expires, they'll give the family 100,000. Meanwhile, the bank actually receives $1 million. So let's talk about using this for your real estate investment. We are going to use a little example here with a case study of, do you want to take it from here, Jason?
Sure. And, we talk about a lot of times, let me start that over. If you dig around and see what kind of people, what kind of organizations, what kind of companies, what kind of banks, who's doing this, right? And is it something I can do? And it's a resounding yes, I can do it too, right? As you start digging around and seeing Fortune 500 companies and what they're doing, and they're buying life insurance and banks and certain dignitaries, right? A fun article I saw on President Biden when he had to disclose his finances showed he owned zero investments and 6 whole life policies. Well, you start scratching your head going, well, what are these guys doing? Why that? Guys like that are not, they're not poor, right? And they're gonna, what is it they know? So here we want to give you a very practical example. I love using this example because it really takes someone through the life of a real estate investor. So in this example, we've got a guy, he's 31-year-old, married, couple kids. His goal is to get into real estate investing. He has saved up $25,000. He's going to start his business with, let me see the rest of that deck. There, yep. Yeah. So he does. And we first talked to him, my current plans work, right? And it's why would I start an infinite banking policy? Well, it's again, and when we teach people how to use this, it's a both and system, right? It's not an either or. It's not that, hey, you got to put your money here or there. It's do both. Or I'm doing just fine with my returns on my real estate. Well, what if you could do that plus make an extra 3 to 4%? What if you could do that plus above that, be the bank and make all that money as well? Or what if you could just skip that and be a lender for other people, right? I always ask people, well, what would life be like if you never had to pay interest to an outside bank again? Tonight, we're talking about real estate investing, but think about all the times you go to a bank and pay interest on something, your cars, your homes, credit cards, all of this, right? What if you could build up your own system where you be the bank? So his goal, he wants to get more rental properties, buy holds, creating passive income. It is a busy night. You may hear some sirens. And create passive income, right? That's what we want to do when we get into real estate investing. He wants to maintain his current standard of living. He doesn't want to take a big pay cut just to build this banking system. He doesn't want to have to reduce his lifestyle, even at retirement, right? And this is something which we'll show you tonight. We'll take you, hey, this guy's going to start out in wholesaling. He's going to work into fix and flips a couple years later. He's going to do that for 5 years or so. Get into buy holds. Maybe he does that for the next 10 years. He's built up enough. He's going to start doing commercial and then take it into retirement. So let's kick it off. We'll go one more. All right. This is what we call an illustration. This is, we strategize with everybody. What is you and your situation? It's not a one size fits all approach. Like Olivia said earlier, take a couple zeros off or add a couple zeros to this. This is just an example of him and his situation, right? If he was going to take $25,000 and kickstart his business. And we said, what if we change the flow of that money, right? What if instead of just going from bank account to business, we go bank account through a policy first, and then we can borrow against that. And now we've kickstarted it. And remember, he's getting into wholesaling. I don't know anybody, maybe one guy I met that's ever quit their day job year one of wholesaling, right? So you're building that wholesaling business in the beginning, and that's what he was going to do. So this illustration has two components to it. You've got your guaranteed side and your non-guaranteed side. We're going to be utilizing the cash value on the non-guaranteed side. So this is a graph form of the same illustration. That's okay. Yeah, the guaranteed, the non-guaranteed has the dividends, and Olivia was talking about properly structured dividend paying whole life insurance. Dividends are profits that the insurance company makes that it pays to certain policyholders, etc. So going off of that, I like the graph form. It's a lot easier for me to read. So we're going to break this down and show you. Let's go one click in. 25,000 goes in the first year, and he's got 18 accessible right away. And so the second year, he's going to do another 25. And now he's a cumulative 43 available, built up. If he goes on throughout his life next, let's say he goes, up to age 37. Now he's got 175 in that he's paid in premiums total. And here's where his cash value will flip. So he's got up to 177 available. Now it's more than he's put in. But he's also been using it along the way. So almost always the way we structure these, somewhere between years 2 and 4, the cash value begins growing more than you're paying in. And then almost always between years 7 to 10, somewhere in there, depends on how we structure it, the cumulative cash value will exceed your cumulative outlay. And that number that spread will always get larger every year. It is not a market-based product. It's not an investment. It will not be tied to the market. When markets decline like they've been, everybody's cash values are staying the course. Their growth in there.
This is important because a lot of folks, are looking to retire right now, and they take a look at what their accounts are doing, and they're like, well, shoot, I have to work another 5 years because the market just took a dip. This isn't tied to the stock market at all. And so there's no risk involved regarding okay, do that and do something like this where, if you have IRA, 401k, whatever it might be, if the market takes a dip, you could still retire because you borrow from your policy. And those are, I'm getting ahead, but those are loans that you don't intend to pay back. When you're ready to retire, you're pulling money out as a loan from your policy because loans don't require taxes. And anyway, there's a lot of other benefits to it. But the loan will be reimbursed when you graduate and pass away. It comes out of the death benefit.
Well, see, next, one more click. We'll see, kind of fast forward all the way to age 65. If he stays the course, he will have paid 560,000 into the policy. He will have racked up 1.4 million in cash value, and he's been using it along the way, right? Borrow, pay it back, borrow, pay it back, borrow, pay it back. It's not one time, one loan at a time, right? Maybe he's got 10 loans out, and he's set up different payment structures for each loan. Maybe he's doing some lending for himself and some private money lending to others now. Then one more. Okay, so this is back to that illustration, same numbers we just talked through, right? Year 1, 18,000 accessible. Year 10, year 7, 177. 20 years in, you've got 467 paid into the policy. He will have built up 675,000. And you notice that cash value column always goes up. As long as you're putting money through your banking system, that money's always going up. So what's next? So let's use this practical example. 25,000. Put it through a policy. Next, he got 18,000 accessible, so he's going to take that out in wholesaling. Someone mentioned earlier in the chat, how can we use private money for wholesaling? So he's funded his banking system, right? And so now he's going to take 18 out, use it for marketing, earnest money, etc. Say he's got a modest goal for wholesales the first year. He's going to make about 45 grand. So take that money next, and he's going to pay back the original 18 loan. He's going to take the difference next 25 and pay the next year's premium with that. He didn't quit his day job, right? The first year he was getting into that. So he's still going to pay his bills, but he's got this system that's going to start paying for itself through his company, right? The profits are going to fund his banking system, and then he's going to take excess. Year 2, 43 in cash values built up. So he doubles down on marketing, $25,000 loan, marketing, earnest money, etc. Say he does 8 wholesales the next year, 80 grand, pay back that principal loan, pay the next year's premium. He's ready for fix and flips, rinse and repeat. Plus the profits, right? So yeah, that year he's got the pay back the loan, pay back the premiums. Now he's pulling profits from this. So he's ready to move into fix and flips. So now by age 32, he's got 43 available. And you can fund a small fix and flip. By that 3rd year, he's got 68,000 in cash value available. So he's not out that he's now put in 25 a year. He's not out 25 a year, right? He was out the difference that first year. He was out a little bit of it the 2nd year. But you notice year 2 to 3, he went from 43 to 68. So by that 3rd year, it's growing more than 25,000. And then that spread gets larger every year. So let's say he continues doing this year over year. He's got 68,000 in his budget for construction funding on a fix and flip. That 3rd year, 94 built up the 4th year, all the way 7 years in, he's got 177,000 built up in cash value, right? Plus the profits you're going to make from the deal. And now he's got 200,000 by year 8 that he's built up. Let's show you what you can do with 200,000. What, if you want to type it. If you had $200,000, would you buy pay cash for one property? Clearly not in Denver. Or would you buy 4, put down payments on 4? Hopefully it's 4, right? We like leverage in real estate investing. So if you had $200,000, let's take that example, right? He's built up $200,000 in cash value inside his policy. Now, again, I like these detours. I'm like, okay, this thought. So jump in wherever you want, right? If you're already doing buy and holds and you've already amassed a bunch of money in your savings account, and you're piling up that savings more and more. So you're doing something similar, right? Except in your savings account. So all your profits are building up, right? But it's sitting in your bank account, not doing anything until you have enough, right? So 200,000, we borrowed from the policy, so you can jump in at any point. We pulled some average numbers. If 1,500 monthly rents, annual insurance, M&R, property taxes, management fees, etc. Say we break that up, that 200 into 4 properties, that's 50,000 a piece. Say it was a 3.5% loan, and then finance the rest of it. 3.5 right now. That's hard to get right now. That's just shifted in the past month, right? So what's it look like? Now, if you borrowed that 200 and you said, I'm going to take 10 years to pay that back, along with my whatever mortgage I have, 15, 30 year, whatever you want to do. But I'm also, including my mortgage, I'm also going to pay my policy loan back, whatever I borrowed, and continue funding the policy. So over 10 years, he pulled that 200 out, and he's going to begin paying it back over a 10-year period. The math of this particular one, he will have a net cash value growth, and net means we're factoring in the cost of premiums on that far left side. So even after the cost of premiums and everything, he has a net cash value growth of an additional $148,000. So let me show you that. Now let's go to the next slide. Now, not only did we make all the rental income on the 4 properties, so you $1,900 a month. Now you've added that $150,000 cash value growth over 10 years, above and beyond your rents. Now you've got an extra $150,000. Can you go put a down payment on 3 more rentals with that? Sure you could. And you've paid back that principal 200. So you could go buy 4 more with that. So as you build it, you can constantly be turning it over. So you bought 4, let's say, in the beginning. You kept that going, you paid that principal back, let's say 10 years after that. You could do it sooner, but let's say 10 years after that, you've got that full 200 back plus the 150 net. So now you can buy 7 more. And now, what do we get? You got 11 properties. All of a sudden, now you're the bank. Now you've changed the game because you are financing your own deals, right? Or don't leverage 500 if you need to. I wouldn't recommend it. If you can leverage the bank in real estate. But if you want to pay cash for it, pay cash for it, and set yourself up with a mortgage. All the same, I know a guy did it for his private residence, right? He just paid for that, and then he'll just pay a mortgage back to himself. So 10 years later, remember now he's 48 years old. He has amassed $500,000 in cash value, right? Commercial, what can you do with multifamily? What can you do with $500,000? Okay. And we have examples of that. I'm not going to get into it tonight, but you can do a lot with $500,000 of your own money, plus what you can leverage with the outside bank, right?
So what this isn't calculating is what you're making off of those other investments.
That's right.
And so, a lot of folks are like, well, the early return on investment isn't this. It's like, no, just wait, because this is not the get rich quick game. This is the long, slow play. But also those that are looking, maybe you're more advanced in years, the system still works. And so you're getting paid to use your own money while you're still continuing your same plan.
Mm-hmm.
So let's look at the retirement options.
Yeah. So by retirement, let's say he's going to retire at 65. He's put $590,000 into the policy throughout his whole life, built up $1.4 million in cash value. Now, by 70, he could live on, did I put in the slide right after this for,
Nope.
No. Okay. So, by 70, 590,000 in the policy. Look at how much he put in from age 65 to 70. He didn't pay anything because we've paid up the policy basically. But it's still, the cash value still grew from age 65 to 70. It still grew from 1.4 to 1.74. And mind you, the spread from the 590 to the 1 point whatever is not taxable because you will always access it as a loan. And the IRS does not tax on loans. You'll always borrow against the policy, even at retirement. And that's how, and we carefully say it, like there's a way to effectively have a tax-free retirement if you build it right and you access it right. You're not cheating the system. You're playing by the book doing this. So the math of that, by age 70, he could supplement retirement by $125,000 a year, never have to pay it back. And when he dies, it'll pay the difference. So let's do 100,000. Yeah. So age 70, he's got 100,000. He's paid up the policy. We're not going to pay any more premiums. On that far left, you see it goes from 61.55 a year to 0. And then we're going to start supplementing retirement by 100,000 a year. Next. Yep, there's a 0. One more. And over 10 years, he's paid nothing into the policy. It still is growing, right? The dividends are still paying in. And this, my friends, is how we can create generational legacy. He can do this. For this example, we've got him 20 years pulling out $100,000 a year. That's $2 million. At the end, let's say at age 90, he passes away. He's got a $2 million he's pulled out, plus the interest it's accrued. The death benefit will still, so what'll happen is it'll reduce the death benefit. What they'll do is they'll take whatever outstanding loan and interest you have, they'll take that away from the death benefit and pay the difference out. So the way we've structured this and the way the velocity of it is going, you won't ever catch up with it. And the way we've illustrated it here is he will have pulled out 2 million over that 20 years, and it'll still pay 1.4 to the beneficiary. But we don't stop there. This private family banking system is to be used throughout your entire life. How can we use it even for the next generation? And this is my favorite slide. So we can take it and we can, the first generation has to start it, right? Somebody has to start it for it to carry on. So parents, let's call you the parents, right? We start the first round, the policies. We use the policies now throughout our whole life to benefit from. And then the kids are insured. And then when we pass away, we're going to fund that death benefit. Will fund the private family bank, be it a trust, whatever you want it to be. Children are going to use that family bank throughout their life. Their death benefits are going to fund the family bank even more. Grandchildren are also insured. And this can go generation after generation after generation. Education is key. It will not happen if you don't educate the next generation. But this is how these private family banking systems go for generations, rather than just squandering it, right? It's different than we get a death benefit, we get lump sums, we go, let's all spend it, right? And it's depleted after one generation, maybe 2 generations tops.
So if you want to read into that generational wealth, I mean, we're all familiar with the Rockefellers. There's an interesting PDF. You can Google it yourself. It's called The Rockefeller Way. What the Rockefellers did. I'm sorry. Yeah.
Yes.
And it compares the Rockefellers to the Vanderbilts. So the Rockefellers established a trust. Every baby born into the Rockefeller family, guess what, has a whole life policy established on them. That death benefit pays into the trust. You can borrow from the trust to start a business or for education, but you are expected to contribute to the family and to continue to grow your own knowledge and contribute to society. The Vanderbilts, they just cashed out what they received, and it's just a name now and a university, but it's no longer a financial powerhouse in our country.
And
yeah, go ahead.
Yeah. How much can one generation away, how much can their life be changed if they never had to go in an outside bank? Right? Imagine if you, day one, didn't have to go to an outside bank. You go to the family bank and borrow, right? And it's a game changer. It just is. But someone has to start it. Let's say you don't have a family, that you don't have kids. Well, that's all right. Olivia, you want to speak to that? You were in the nonprofit sector.
Yeah. So I spent majority of my career in the nonprofit world. And we do have clients that don't have children, have no intention of having children, but they want to establish a trust and give to charities or give to nieces, nephews, etc. But they want to use that money while they're alive. And so there's always, hopefully there's some type of cause or something else that you're passionate about that you want to give and have a legacy towards. You can name any person or entity, a business, anything else, as a beneficiary of all of this. And those entities as well can establish their own banking systems too. So it's most powerful. And the frustrating thing on my side is that this works beautifully for nonprofits. The only problem is that nonprofits have a board, and getting everyone on the board educated enough to make a decision to start this system is extremely laborious and challenging. So that's my biggest hurdle. So all right, so let's just look at this. This is a quote: "What you leave behind is not what is engraved in stone monuments, but what is woven into the lives of others." And so it's just that, it's saying like, hey, this is going to be a benefit for your life. It's going to be benefit for your real estate investments, but it's also going to be passed on as a legacy to somebody else. So what are some of the next steps? Number one, I love to engage the 24-hour rule. I'm actually going to pull up our Calendly's. Hang on, let's I get this all established. because it says that you are less likely to implement this or see how it can apply to you the moment you walk away. The chances start deteriorating in terms of application. And so very simply, just book a time with Jason and I and let us go through a simple situation and just see how this could apply for you. Back to the beginning where we said we're kind of treasure hunters. We help folks, even those that are in significant debt, there's a debt recapturing system where we can recapture the money that you're going to be paying off big credit cards to anyway, let the money flow through a banking system, pay off the debtor first, pay off, the whatever loan that's out, and then start to repay the policy loan. And by the time you're done paying off your debt, you've actually grown your money. So it sounds crazy, but the numbers don't lie, which is super fun. So that's Jason.
It's fascinating. And
Yeah.
don't write yourself off either. Like
Right.
a lot of people go, oh, well, I can never do something like this. Well, maybe it's true, but at least find out. We will tell you, not that you never can, but we've had clients come in and we'll do a financial analysis. We'll talk through income, expenses, assets, liabilities, goals, and objectives, and get the whole picture. And the recommendation may be, hey, doing something like this right now is not appropriate, but here's a plan to kind of get the bad debt under control. Maybe you've got the bad debt out of control right now, and we'll help you come up with a plan, a game plan, a GPS, if you will, to get that debt paid down and be able to free up some of that cash flow to start something like this. And it doesn't have to be, it doesn't have to be $25,000 a year. We've got clients doing $200 a month. We've got clients doing $300,000 a year. We've got everything in between.
Yeah.
It's what's right for you.
Right. Yep.
And that's what we're going to help you do.
So I put the information there in the chat. Hopefully you can see that. And even if we need to reschedule later, put something on our calendar so that we can start to see how this does apply to you. I'm also going to put my email in here, and Jason will too.
So let's take a minute.
Send us an email. Let me just take you through real fast. What does it look like for the next steps? Very practically, this is where you are, is infinite banking education. And then just the conversation and discovery. We're trying to find out, what are your goals? How can we implement this into what you're already doing without changing your cash situation? So we're looking at changing the flow of the money, not necessarily $1 equals one purchase over here. $1 can do more than one thing. We apply for insurance. That's pretty straightforward, but it takes a little while. So we like to start that process earlier than later so that we can be designing a policy, coming up with a strategy while the underwriting side is happening with the insurance carriers. We're crafting a policy for you. So underwriting and approval, the policy is crafted, and then you receive the policy, and you don't pay anything until we hit that finish line. And you actually don't pay Jason and I at all. We're simply the ones that set it up. Unfortunately, like real estate, where you can get your real estate license and go do this on your own, there's a lot more steps that are involved that won't allow you to do that for yourself right now. But like I said, Jason and I, we all started in your seat where we were the student first, and now we've become the teacher because we're passionate about it and we love it. So let's go ahead, and I'm going to stop sharing my screen. And so hopefully that chat will pop back up for you too. Do we have questions? And feel free to unmic yourself as well. And we'd love to just speak specifically. And we have some other slides and stuff too, if we need to pull those up to help explain something or review one of the concepts.
One of the most common questions we get is, does it have to be on me? Or I'm too old, I'm not insurable. I feel like I'm not insurable. And to that we say, interestingly, you can be the policy owner. So you can insure your kids, your spouse, maybe a business partner, somebody with insurable interest. As the policy owner, you have access, the right to utilize that cash value. And so you don't have to be the one that's insured. Maybe you have poor health, but your spouse is in far better health and way more insurable, and the rates will be better. The cash value, ratio will look better, and we help you figure that out, right? But to that, I also say, don't write yourself off ahead of time. Let's explore those options, and sometimes there are some really neat, creative ways to get this started for you. And you feel free to unmute. If you've got a question, feel free to type in the chat box. We'll just kind of spend the rest of the time, we'll answer any questions. Maybe we were thorough enough. Maybe there.
I have a question.
Yes.
Yeah, Kyle.
Okay, yeah. So my name's Kyle. I have a couple policies on my kids right now.
Great.
And when I went to set up my policy, they told me that I wasn't able to do it just due to the fact that I got a felony. Is that accurate? And then if it is, about how long does it take in order for you to open up a policy?
Yeah. So we can send hypothetical questions to our underwriter and without saying who you are or the situation, and say, what would you say? Or what would you do? The reason why someone might have had some hesitancy is that actually the system, and this is where Jason and I have to do our due diligence and continued education, is often used for money laundering. So we learned how to money launder by learning how to do this, funny enough. And so that might be part of the reason why there might be a record there where they would say like, hey, you need to wait a certain number of years. But that doesn't mean the situation's impossible. Like I said, we can talk to the insurance brokers. Maybe there's someone else in your family that could be the bank owner, or we set up a trust and the trust is the one that owns the policy. So there's a lot of different options. We don't just kind of write things off just because we received a no once. We tend to look at it, study it, and figure out like, okay, what's another opportunity, or how else could we come at this?
Yeah, that's something we'd have to look into. And also remember, it's not necessarily just a plain Jane whole life policy that may not work that way. It may not be structured very well. And so, a lot of people, our uneducated perception of whole life insurance is it's expensive insurance, right? We go, oh, we put all this money in, but we don't have access to any of the cash value until later, and it's nominal, right? And that's because it's structured a totally different way. It's structured strictly with death benefit in mind, period, right? And so, be it your kids' policies and you're the policy owner, and that can play a factor as well. If there's not enough in there. Good question, though. We can look into that.
And then just one more question. I know that you guys were just saying like, and
Oh, we lost you.
Well, you got muted, Kyle.
dollars that you put in or whatnot.
Kyle, you got muted mid-sentence. Can you start over?
Yeah, somebody was trying to call me, my bad. So basically, do your PUAs, your paid up additions, have to be to a certain number before you can withdraw and start making, before you can withdraw out of the account? Or is it just, is it a certain number that has to be in there before you can pull out? Because I know in the example it said 20,000 and then you have 16,000 to pull out immediately. So yeah, that's kind of what.
As soon as it's funded, you can borrow it back out. And so we have clients that send policies up and borrow the money back out the following week. And that's important for real estate investors. Or you put it in and you let it wait until you have a great opportunity. If the market's turning like everyone's expecting, this is a perfect time to be setting up a policy and just wait. Your money's going to be making money, whether you're out there buying properties right now or not. And then when the market drops and you see a great deal, you can call us up and we can issue a loan to you and have it in your bank account within 3 to 5 business days.
Okay, so it's not a certain amount of money that has to be into the account before you can withdraw a loan out, or is there?
Not with how we structure it. That being said, there's two components to premium, right? There's a base premium and then what you said, a PUA, paid up addition.
Right.
So strictly speaking, for the paid up addition portion, now it's also how it's structured. Do we want more cash value early, or do we want more cash value later? Or do we want to kind of evenly growing throughout the whole life? There's lots of ways to structure it, and that we kind of utilize your goals and objectives to structure it a certain way. But typically, once you pay a premium, most of that PUA is available right away as soon as it's in there, year one, day one, right? And you can access that.
So we have a question regarding an IRA.
Yeah. So,
Okay.
Oh,
Are you there?
So Randy asked a question, can an underperforming IRA be converted to this policy? My short answer, I'll let Olivia expound on it, but my short answer is we are not allowed to make recommendations on qualified accounts. We have had clients liquidating qualified accounts to start policies, but they have also worked with accounting and the firm that's managing the money, and they've run the numbers and it made sense for them. So you kind of have to navigate those waters. Is it possible to use that same, you can't do a 1031 exchange on real estate and convert anything over. You can't do an exchange of any kind because it's not an investment product.
So here's one of our questions. Do we think taxes are going up or down? Any takers?
Yeah, what do you guys think? Taxes going up or down in your lifetime?
Up.
Up.
Yes.
Yeah.
So is it better to pay taxes today or taxes in the future?
today.
Today.
That's right.
So if you have money that is sitting somewhere and you're concerned, let's say, I'm not saying pull it all out of an IRA or anything like that. I'm saying do a tax evaluation. What is going to be your tax burden this year? Is this a good year to take? And I don't know, Randy and Grace, if what your age is, if you've hit the 59 and a half bracket where you can take it out without penalties. Something I'd never consider is talking to a friend who does this, and somebody's, he has a match 401k. And he's like, yeah, I'm just going to let that match grow for a little bit, and then I'll take the penalty and I'm going to convert it into a whole life policy. And it never occurred to me. I'm like, I think of that penalty as like prison, and that we're not allowed to break the money out of there, that it's stuck forever. And he's like, well, if it's grown that much and I can put it to better use somewhere else, I don't mind paying the 10% fee and then the taxes on top of that, and then put it into something where I'm never going to pay taxes again. And so that's part of the evaluation that we can help look at is, what is in there? How much would taxes be? Talk to your CPA, get all of the information from them. We can pop it into a spreadsheet and look at illustration options, and do the numbers make sense? And so if the numbers make sense, well, then you have all the information you need to make an educated decision, not a wild guess. Now, there's a lot of other guesses and things that are out there. It might be taking a portion of that. If it's underperforming, then maybe some of it, but not all of it, because you want to regain some of what you've lost in there. So there's a couple of different ways to come at this, or you can hedge against that. Let it stay where it is. We do an evaluation of where are the other opportunities within your budget and finances, and look at starting a system so that when you are ready to retire, and if the market drops again, you're pulling out of your policy to pay for retirement, and you can let that IRA sit and grow and recover. And when that grows and recovers, take it out of your IRA and then let the policy just sit where it is for that year. And so you have an opportunity to not be tied to one option, especially around retirement. And then silence.
We're taught to do a certain thing with our money, right? From day one, almost. We're taught, put your money in qualified accounts and save up for retirement. And that's your option. And hope Social Security is still alive when you get there as well. That's what we're taught. And we're never taught, do we have other options, really, above and beyond that? When it comes to building up for retirement kind of thing in the traditional world, right? Real estate investors, I think real estate investors are one step ahead because we're already finding ways to create passive income. And it has nothing to do with your retirement accounts, your qualified accounts, right? Generally, or you're using qualified money, right? Self-directed. But just like that, when Olivia asked, if I ask most people, I'll sit with them and I go, you think taxes are going up or down in your lifetime? Almost everyone says up, especially nowadays. It's got to go up. And then, but if I asked at the beginning of our conversation, generally speaking, would you rather pay taxes now or later? Instinctively, we're taught, let's defer taxes. Let's pay it later, because that's later. Don't worry about it later. I go, yeah, but you think taxes are going up, so why do you want to pay taxes later? And so you have to factor that in, right?
Hey guys, I've got a question. It might be kind of simple, but I'm not very familiar really at all with life insurance. You're saying that once I've built up some, principal in my life insurance policy, and I'm going to use that to fund my activities, I'm going to be paying interest on that. Is that's just sort of how things go when you withdraw from your life insurance policy to use it for other purposes? The insurance company then sort of converts to a sort of quasi bank, and they're letting you take your own money and they're charging you interest for that. Is that right?
That's part right. If things we didn't get into a little bit where your policy has a guaranteed growth rate, right? They're saying, hey, your policy is going to grow, say at 3%, right? Uninterrupted, a year over year, not including dividends. That's on the whole. And then you're going to borrow against the policy on a portion of that, right? At say the 4% example. So even if it were, you could borrow the whole thing, it grew 3, cost you 4, truly cost you 1. So it's still a benefit because you can't borrow 1% anywhere else, but your money is growing uninterrupted. Like Olivia, you showed this example, and then.
Yeah, so I was just bringing this back up because this is the whole point. So it's not saying, number one, that you have to wait for the pool to establish. The moment money's in, you can borrow it right back out, and I've done that. Number two, the reason why it's important to pay the interest back on that is that it does allow it to grow at compounding interest and uninterrupted, just like Jason said. And so it's wrapping our brains around this function and like, why do I pay interest on my money? Well, it's because it's a bank, and that money is going to grow for you, and you'll make money in more than one place at the same time. And so once you see some of those numbers working and the how and why behind that, also the loan language is very important. Can you withdraw? Absolutely. Once you withdraw though, that money is gone, and that's not going to grow for you forever. The loans, even if it's loans that we have no intention of paying back, like in retirement, we call it loans because we don't need to pay taxes on loans. Also, that loan will be reimbursed by the death benefit over here, which will be significantly more than the outstanding loan balance. And so you can take it out in retirement without worrying about paying it back. And so because it'll be reimbursed by the death benefit.
Pull up, Olivia, either one of those graphs that we had. Just to kind of reiterate the same thing. Let's jump in right here. Let's jump in age 38. He's got 200,000 in 207 in cash value available. You guys see that right in the middle. The purple, it says 207,387. See, he borrowed. We use that 200,000 example, right? We borrowed 200,000. Let's say we held it out for 20 years, 38. Well, let's say we held it out from age 38 to 60. 65. So I'm going to do 65 since the box is there. You see, you kept that 200,000 out, even though that 200,000 was out the whole time. As long as you're paying that interest every year, the cash value is still going to grow to 1.4 million gross. Your access is going to be minus the 200 you already have out. So you'll still have 1.2 million in cash value available. So it's when we talk about it's growing uninterrupted, it's not growing on what's left in there. It's growing on the whole as if it never left. And there is no other vehicle out there that can do that.
So Kyle's asking, why pay the loan back at a law if it'll just be reimbursed by the death benefit? All right. So if we are still young, healthy, and we're in working years, it's important to pay those loans back. Why? Because the interest on those loans can also grow and compound. At a minimum, pay the interest on the loans. And that can be a strategy as well. But we're looking at growing this and establishing it to do more than one thing. And so like for my family, we'll need to be buying cars. I'm going to be borrowing from our family bank to buy those cars. We just borrowed from our policy again to buy our first real estate investment. That real estate investment is going to be the one paying back that loan. The car loan, we're going to take responsibility for and pay that back just like we would any other bank or any other establishment. You would, if you pay cash for cars, you still have to save up again to buy your next car. But why not have that money grow while you're saving up for your next vehicle? And then at that point, you're no longer giving up, the lost opportunity cost of that. Or something else I was going to say. Okay, so also you don't want that interest to be compounding as well and bankrupt your policy. And there are situations for folks with other companies that take out policy loans, they don't pay them back, and that interest starts growing and compounding. There's a lot of options. We can have the dividend help pay back that loan. There's other options to make sure the policy doesn't collapse and kind of implode on itself. But this whole thing works when we're disciplined to pay back your policy loans and have the understanding of the banking aspect. And so, so anyway, for us, it's super important. If you're wanting to just put the money in, pull it right back out with no intention of paying it back, that's not a winning strategy long-term. So you're welcome to work with somebody else for that, but that's not one that I'm going to be.
I mean, you're setting up your own banking system, right? And so you want to be an honest banker, as we say, right? Be an honest banker, especially with yourself, and pay yourself back. The interest bill, now mind you, they're going to send you a bill once a year for the interest that's accrued that year. You can pay it or don't pay it. We always say, hey, pay it if you can, at least the interest, even if you didn't pay any of the principal back. But even if you don't pay it, they're just going to put that on. That'll be the compound on the new loan, right? The new loan balance. It'll become your new loan balance. And then the interest will compound year over year. So that's
what do you
I'm
mean they're going to send you a bill every year for the interest?
I didn't catch that.
So what do you mean they're going to send you a bill every year for the interest?
Yeah, so that when we talked about that 4% example, so whatever interest you've accrued on that loan that year, they're going to send you a bill for that year at the end of the policy year, and that you can pay or don't pay. Now, there's a whole nother layer that we haven't gotten into. We probably won't camp there tonight much, but you have your own banking system. And let's say you're going to loan your real estate investment business the money. Charge your real estate investment business 8% if you want. Now, the real estate investment business is going to write off that 8% because it was a business expense, right? Interest. So now, like Olivia said early on, that's the way you're writing off even that interest that you have to pay because it's a true business expense.
So I'm just confused. So there's a bill on top of on the interest, because like I said, I got these two policies right now. I got the two policies, one on each of my kids, and I pay $100 each month for each one. It's like 50-something bucks for the PUA, like half goes for the paid up additions and the other half is for the policy. So you're saying there's another bill at the end of the year?
If you took out a loan.
If you had a loan.
Oh, okay.
Yeah.
If you take out a loan.
If you borrow from the cash value. Yeah.
Okay.
Another common question we get is, does it show up on my credit? And guess what? Nope.
So I have a couple clients that, number one, when they're doing real estate investments, banks love, traditional banks now, they love that you have life insurance and they love that you have a cash value. And I've written letters to underwriters for bigger deals and loans for clients explaining the cash value, explaining that if they need to borrow from this money to pay you, the lender, it's an unstructured loan. So they're not obliged to pay this back. And that's all they want to know. But rather than, is it the Freddie Mae, Fannie Mae? I always mix it up. Sorry, Fannie Mae,
Fannie Freddie.
Yeah,
yeah.
Fannie Freddie. The limitations on that, at a certain point, you have to have 6 months of mortgage payments sitting in a bank somewhere. Guess what you can use as your bank? Your infinite banking concept. And so your policy loan will qualify as that bank that's just sitting there, but actually growing at 4, 5, 6% interest for you, not the 0.013% that Wells Fargo will give you.
Mhm. So Greg asked, if you start a policy, what's the realistic turnaround time from application to policy establishment in order to take out a first loan? Realistic? Yeah,
Some depends on you, some depends on the underwriter. So it's how fast can we get your medical exam done, the application submitted. We try and do as much as possible to make sure make that as fast as possible, especially if we know the questions they're going to be asking us. But there's
30 to
always
60 days.
surprises, and
Okay.
things come up that can delay that process and make it take a little bit longer. But there's things that we can do ahead of time to help make it expedited. So.
Yeah.
So this is Greg's wife, Sarah. Hi.
Hi.
The reason we asked is because we had set aside money in an account to take to closing, but we probably need it in the next 20 days. So we were just curious if we had time to, structure it this way before just writing them the big check and not going.
Good luck. Send
Yeah.
us an email. Let's figure that out, because we could always put in, if you could, a couple things. If you could go tomorrow and get your medical exam done, that'll get it ready. If we get all the information ready to submit to the underwriter, and at this point, we actually have our own underwriter with the carrier, that if we flag one as like is very special and need to move right away, he'll do that for us.
Okay.
That's not promises, but up to some certain limitations. Like I know what some of those brackets are, and so we can move fast if we need to. And so
if we don't run into any, if underwriting doesn't run into medical hangups, things they need to ask more questions about, stuff like that always just kicks it back. I mean, if you've ever bought a property with a lender, you go through the underwriting oscopy, as I call it, right? And you never know what they're going to ask, and it sometimes can be like that, but if everybody's in good health, we got all our ducks in a row, we can get it moved through pretty quick.
And do you guys have like certain medical providers that do the physicals, or do you just go to if we just had our yearly physicals, we can just submit those somehow?
They have a specific things that they're looking for. And so you can go to a clinic and get that done quickly, but they'll give you a specific clinic that will know specifically what to be doing for it. And then, or a nurse comes to your house.
That's what I'm more familiar with other policies, is they come and do the blood draw and all those questions at home.
Yeah.
So,
yeah.
Okay.
Yep. And if we know, again, one thing that can expedite it is if let's say we talk on Friday, we set up, our strategy and plan right away, or if we know that hey, we want to get this money in, and then be pulling it right back out. And then the medical exam's done right away. Next week, the underwriter could be looking at your situation, and then we can, let them know hey, we've got a rush on this one. So
Right. So there was What Would the Rockefellers Do is the name of the book that was mentioned earlier. We recommend Becoming Your Own Banker. That's a book you want to read. It's like 85 pages, and it's kind of the infinite banking Bible, for lack of better words. And that's really where you want to start. Now, What Would the Rockefellers Do is a good book, but you want to start with something like that to really dive in.
Yeah, and do the infinite banking books, but supplemental reading is What Would the Rockefellers Do.
Yeah.
I'm trying to look it up. Everyone's trying to sell it. I'm like, it's a free PDF somewhere. Buy it for $50. I just download it. So,
Yep. We got time maybe for one more question. Going once. Going twice. Now you've got our links in the chat if you want to schedule a call. You have our email addresses in the chat. You can find us on the ICOR website. If you didn't write anything down, look us up. And we would love to chat, just answer any questions. I know you'll have aphorisms after we hang up the call. Oh yeah, I wonder. I'm happy to answer those. If you have existing policies, we're happy to look at those, see how they're structured for you, see what they're for you. A lot of people have VULs, IULs, variable universal life, index universal life. We can look at those. and explain those to you. A lot of people don't understand those, don't understand what they have. So happy to look at those for you guys.
Hey, can you open the policy in the name of a company or a trust?
Yep, trust can own policies, LLCs, all of that. S corps, C corps, all of that fun stuff.
The insured has to be a life,
Yeah,
but the policy owner can be those. Yep,
Okay.
good question. All right, guys, we appreciate you taking the time. Troy, I don't know if you want to wrap us up if you're there, but thank you again. We love what we do. We eat, breathe, and sleep it. We practice it ourselves. You know, it's not just something we sell. You know, we live it and live it and love it. Right. So thank you guys, and we hope to be chatting with you guys soon.
Thanks, Jason. Thanks, Olivia.
all right. Thanks for joining
Thanks
us.
you.
Have a good evening.